Welcome back, guys. Today we're going to analyze Amgen, a massive pharmaceutical company. Now, the thing about pharmaceutical companies is they're kind of difficult to value because they have a lot of different products and they have products in pipelines, and you don't know which one is actually going to grow and which one's going to die off. Although they do tend to be fairly consistent once a product hits the market and it becomes adopted by some people, then they end up buying it like over and over again. So today, we're going to analyze Amgen here. They are a $150 billion company, and over the past 5 years, they grew by 52% with a 3% dividend yield. That would slightly underperform the S&P 500. Their all-time chart looks pretty decent. Yeah, these are types of charts that are pretty good to see. Although I don't know if this company will actually outperform the S&P 500 moving forward. It doesn't really seem like they have a lot of growth. So let's take a look at the financials. Taking a look here, their revenue has been pretty steady. It grew up to 28 billion in 2023, and they are expecting that to grow up to 32 billion moving forward. Probably because they did a massive acquisition of a different drug, I'm guessing. And we can see that on the balance sheet, although I'm not really sure which drug it was. Also, they have really high margins. Like, look at this gross margin, super high. Probably because they charge a ridiculous amount for their pharmaceutical products, and then you've got to pay your salespeople and whatnot. And yeah, they've got great margins. Their share count, they've been buying back shares, although not in the last year because of this massive acquisition that they did. You can see that their assets and their liabilities jumped up to 90 billion, and also their debt. Their debt jumped from 30 billion up to 54 billion. Well, at least their net debt and their total debt jumped. So this company actually has quite a lot of debt. 54 billion is a lot of debt, especially when you're only making 7 or 8 billion in cash flow. It would take like 8 years to pay that off. Yeah, so it's kind of a lot of debt. Also, they're in terms of their assets are pretty much all goodwill. So yeah, net intangible assets, it's pretty much all like goodwill and other intangibles. So those, if you have to take a write down on those assets, that's not going to be good. Taking a look at what they do with their cash flow. The last year they didn't do any buybacks, but they paid quite a substantial dividend, and they took out a lot of debt. Let's take a look at, oh yeah, so this is why it's tough to value these businesses, or the pharmaceutical businesses. It's because they've got all these products. Like, they literally have like 20 different products, and they all sell like a pretty decent amount. I mean, some of them are like pretty negligible, but yeah, and then you don't know which ones are going to be growing and which ones are dying off. So that's what makes it tough. Although they did grow their product sales 20% year over year, driven by primarily volume growth, it seems like. So that is one good sign for this company. Let's take a look at the analyst. So the analysts believe that they're going to see $18 a share this year. I think that's way off. I think they're going to see way less, but we usually use the analysts for these types of predictions. And the revenue estimate, they're projecting to grow by 17%, primarily due to that acquisition, and then to flatten out at about 3.5% from there. Let's take a look at their stats to see how. So they're actually shorted by 2%. That's actually pretty high for a pharmaceutical company. So that's kind of interesting to see. Let's plug that stuff into the DCF model. Here's my DCF model. I plugged the EPS estimate, the revenue estimate here, buybacks of 0, net debt of 54 billion, quite high, so we have to factor that in. Discount rate of 10% because I want a 10% return on all of my stocks, and an exit multiple of 20. That's pretty normal for a pharmaceutical company. Exit multiple of 20 makes a lot of sense. In terms of growth, I don't really have them growing much from after their acquisition, and so just an earnings growth of 2%, I think that's fair. And in that case, you're looking at a fair share price of between $100 or between $200 and $300. I'd probably put them at like 250, 260, just because they've got so much debt. That makes it tough. You could maybe push it to like 270 where they're at right now. But also, I don't really think they're going to hit this earnings estimate. So this should probably be a little bit lower. This, I think, is more realistic, this revenue margins model. And using the revenue estimate, and I think they're going to have a profit margin of 20%. Because if you look back at what they did, let me show you. Let me get to the right page here. Okay, right here, they did 24% last year. Although in that last quarter, they only had 10% margins. They could maybe get back up to 20. Yeah, I think they'll get back up to 20, maybe not 25. I think that acquisition, so they did an acquisition in Q4 of 2023, and that's why their net margin is so low. Now, oh wait, my bad. Now, are they going to be able to work through that that margin difference? I think they will eventually get back up to 20%, but they might not get back up to 25. We'll see. But yeah, back to the model. I have a profit margin of 20% set, and their revenue growth very steady. Because if you look at their past, they haven't really grown their revenue all that much unless they do acquisitions. And so with this, then you're looking at a fair share price of 205, which is much lower than their current price, and a fair share price after debts of 103. So I'd probably put them at 170. Now, maybe they get back to 25% margins after a little while. I don't really see them going past 25% margins. But then we're looking at a fair share price. Probably I'd put them at like 230. And probably if you bought them today, you're looking at like a 7% return. That's 70, my bad. Oh my gosh, 7%. Yeah, I'd say probably like a 7% return you'd be looking at. So yeah, I'm not buying this stock. I really don't like pharmaceutical stocks because they're very difficult for me to understand. Like the different revenue sources that they're going to have in the future. So I tend to stay away. And also, they usually don't really have a lot of growth. And like they're really steady, but it's tough when there's so many other stocks that are better than this. So yeah, that's why I stay away. Let me know what you guys think in the comments. Also hit that like button, and I'll see you in the next video.